Welcome back to Revenue Margin, brought to you by Rob Melening. Today I'd like to share a brief update on the U.S. economy, where we're standing now, and what leading institutions are forecasting for 2026. Ultimately, what does this mean for your business, your investors, employees? So let's get started. Looking at the present, according to the Federal Reserve, or what's mostly commonly known as the Fed, recent indicators show growth in activity, but an outlook is still neutral to slightly pessimistic, according to what they've been reporting right now in the marketplace. Our real GDP grew in the second quarter of 2025 by 3.8%, which is really great. Yet the September 2025 projections are still showing that the full year of 2025 is going to be projected to be around 1.8%. Inflation continues to remain elevated in certain markets, and the labor market is really tightening with the signs of showing moderation associated with growth. In addition, the Conference Board, which has flagged the U.S. economy, is heading towards significant slowdown in 2025 at the end of the year, and estimating real GDP growth to be around ultimately 1.6%, so slightly less than the Fed. And warning that tariff pressures are really the one driver that is an unknown factor that is really causing them to believe that that's going to cause significant continued decline in 2026, along with some economic pressure associated with what imports are going to be allowed, specifically around certain things like the rare earth arguments going on with China today. So the key takeaway, we're talking about moderate growth. We're talking about increased uncertainty associated with some aspects of industry. We're looking at strong labor and consumption fundamentals, but the headwinds are related to inflation, tariffs, and global trade and policy uncertainty associated with the government right now. That's quite obvious. I think the other key thing is that there is being offset by the Fed. Interest rate reductions are projected in the first half of the year, potentially 2 more reductions in the first quarter is what I've read. And hopefully that will help offset some of that. So continuing to look in 2026, though, what do some of these institutions report right now today? The Fed summary of the economic projections released in March of 2025 had members showing a slower growth in 2026 than what we're seeing in 2025, with uncertainty really elevated. I believe the other one that's really quite interesting, I love the Conference Board. It's really forecasting higher risk for the U.S. economy in 2025 and into 2026. Talking once again about the tariffs, uncertainty, and weak manufacturing orders. That is being offset, though, because there are some manufacturing jobs that are being moved back to the United States and are being picked up. Walmart recently had an interview where the CEO of Walmart was specifically talking about that they're actually seeing reductions in some consumer prices and really reducing up to 20% versus the prior year and getting back to where we were in 2021 to 2019, associated with some personal purchases at the grocery shelf. So there is some positive news associated with some of these items, but we're going to continue seeing uncertainty associated with key markets. But we also continue to show that for 2026, people are projecting 1.5 to 2.5%. And it's really going to be on the basis of how all these policy adjustments are going to affect the individual U.S. economy. And it's hard to project associated with the uncertainty because there's not a consistency of the methodology and the outcome in response to some of these items. So this is kind of unique territory we're going into and the way that Trump is actually operating the economy. It's not necessarily a bad thing, but it is something that's uncertain, and you need to be prepared for that. Ultimately, what does all this mean to you, though, as a business leader, an investor, and potentially you as an employee? Businesses, if growth is going to be modest, it's going to mean that investment decisions are going to need to be more disciplined. Focus is going to shift towards productivity, cost efficiency, and selective expansion rather than a broad growth of going associated with just taking any kind of product line. Investors with slower growth and inflation still above target, you might see more conservative returns. You're going to see fixed income and interest rate decisions become particularly relevant if the Fed maintains rates. But right now they're projecting and actually communicating that they're not going to maintain rates. And so I believe that they're going to probably pull them back to be able to offset some of this pressure so that they don't have a pullback in the economy. I think workers and employees, you hear all the time about all these layoffs occurring, and you see different aspects associated with certain markets, movements, and what's going on. I do believe that they're going to give way to more competitiveness for jobs. I think wage growth may be very moderate in comparison to expectations. And I think individuals, for managing inflation risk, is going to maintain importance. So you're going to need to look at price increases, maybe persistent at times. You also want to take advantage of maybe delaying. If you're going to refinance your home, if you're going to maybe buy something, you might want to wait until after the first quarter, into the second quarter, to prepare for the higher or lower potential interest rates, because I believe the Fed's going to probably reduce it and continue to do so over the next 3 to 6 months. Ultimately, I think my recommendation would be that you need to review your cost structure. You need to maintain flexibility in the marketplace and not commit to one specific capital plan or overcommit yourself from a cash perspective. I think you need to monitor the interest rate policies and the policy shifts that are going on with government and with banking to make sure that you're not being caught specifically in the marketplace and taking a position that might be going contrary to the market. And don't assume that you're going to go back to a high growth market like we experienced rates before COVID and right after COVID kind of ended. We rebounded quite hard. I think we're going to really see a moderate growth for 2026. Good year, but I don't believe it's going to be as good as 2023 into 2024. With uncertainty elevated, scenario planning is going to matter more than ever. I think companies are going to need to look at and find strategic consultants and incentivize and understand how this is going to affect your business and prepare for that uncertainty. In summary, the U.S. economy is standing in a very solid footing today. Our significant headwinds and uncertainties mean that 2026 is likely to be a lower growth year rather than a rebound to higher growth. That path forward for strategic clarity, operational flexibility, is being prepared for a range of outcomes. Thank you for watching. If you found this helpful, I would love to connect with you. Share or drop a comment below. Everybody always appreciates those. And I'd love to hear your perspective on what you're doing with your organization or field in response to the economy changes and policy changes that we're experiencing. Till next time, I'm Rob Malenik, bringing you Revenue and Margin. I'll see you soon.